For which aspects of fixed income? This has been one of the biggest disagreements that people have had.
Yeah.
There's been this rush into private capital, private credit. Yeah. There's been a rush into T-bills. Where is active management? Where should it focus within the fixed income sphere?
Well, and thank you for asking, Lisa. One of our key messages is that there are opportunities in private credit. This is a super secular trend. After the GFC, big banks, regulation, supervision was changed, and so a lot of credit intermediation occurs outside of banking, and so there are opportunities. But we do say in the essay that we do see froth and valuation in certain pockets of private credit, in particular, mid-market corporate lending. We think there are much better opportunities in asset-backed lending to the consumer whose balance sheet's in really good shape. So we think investors need to be discriminating. When it comes to more traditional bond, the key point now is that investors can get an equity-like return, 6 or 7%, without a lot of volatility or interest rate risk. So that's why our subtext is seize the yield advantage right now. So no longer is there a reach for yield. Investors should seize the yield advantage.
They've been seizing it all year.
Yeah.
And this is part of the problem, right? That we talk about the macro risks. And then there's a question of valuation risks. And I'm stealing your words. I'm just going to be very blunt about it. You talked about that earlier. So how do you sort of weigh that? It seems like that's right now the biggest struggle for markets that are not facing off with bad data.
Right.
They just are trying to figure out whether it justifies the valuations where they are.
Well, again, I think there's an element of the fact that the U.S. last year did outperform globally, and so there is a U.S. exceptionalism theme that is grounded in hard data, and it's natural for markets to put some probability that continues. What we point out in the essay, Lisa, however, is part of that U.S. exceptionalism was fueled by big budget deficits in a fully employed economy, and it's not clear how long that can go on. So I think that markets sometimes do get into these bandwagons. They do extrapolate, and maybe we're seeing a bit of that, especially, I would say, in some other markets.
There was a phrase you used, equity-like returns.
Yeah.
Generational reset in yields, equity-like returns. Why do you and the team think all of that merits a reversal of the traditional 60-40? How are you now thinking about this approach?
We think 60-40 has served investors very well, but at extremes in valuation, it's worth reassessing, right? So if you look at traditional equity valuation measures, the CAPE or Shiller price-earnings ratio or whatever, equities are very expensive historically. Now, that can continue. It did in the 90s. But we do think 60-40 is worth assessing when you get at extremes in valuation. Perhaps, when rates were negative in Europe 5 years ago, that was another opportunity to look in the other direction now. So the reset is not a mechanical chain you should pull, but it is important to step back and see if you want to adjust the portfolio given valuation.
So what, 70-30? How are we thinking about this? Just help me understand a little bit more.
Well, the traditional is 60 equities, 40 bonds. And so, as a shop that sells a lot of bonds, we think 40 equities, 60 bonds could look good for a lot of investors at these levels.